What's up, everybody? Justin Connor coming here with another incredible video here on YouTube, breaking down exactly step by step how individuals looking for funding can maximize their funding opportunity with proper relationship banking and building that internal bank rating. About to break this down in very clear fashion, so make sure you take some notes and get ready to dive right in. So the first thing, our disclaimers, remember this lesson is entirely educational. We are not financial advisors, lawyers, attorneys, or CPAs. This is for informational purposes only and not to be considered as financial advice. You should consult your financial professionals before making any decisions. Cool, so we got that out of the way. So what are we going to cover today? So how are banks rating you for lending? And what can we do as business owners to increase cash flow and increase our approval amounts? So it's going to kind of break down into four separate parts by leveraging cash flow to be able to get larger limits. You have your daily deposits, your total monthly deposit volume and gross cash flow, your daily ending balance, and then end of month balance or free cash flow. And I'll break that down in detail today. So how are the banks rating you for lending? It's really broken down into three separate parts. It's cash flow, collateral, and credit. So let me break that down for you really quick. So cash flow is how much money is the business making and keeping on a consistent basis. That's the first qualifier they're going to determine your credit worthiness. How much money is the actual business making? Because that income is going to determine your debt service coverage ratio. So basically, how much debt can a business take on based on how much cash flow it has, where it can actually support that debt. Two is going to be collateral. So, those are like your real estate loans, equipment loans. Obviously, a commercial building would be considered a collateral loan. So those are lower risk loans to the bank because if the lendee or the person borrowing defaults, they can just go ahead and procure that property or procure that equipment. So there's security behind it. And then the last thing is credit. So that's going to come in the form of business credit or personal credit. So traditionally, a lot of clients coming to us on that initial round of funding, they might not have any business credit established and they might not have any really strong cash flow or even collateral to provide. So we're going to leverage that personal credit to get that initial 100 to 150,000 in unsecured funding. Perfect. Now let's dive into cash flow specifically. That's the purpose of today's training. Let's dive deep into that and make some better decisions as business owners on how we're moving our cash around. So cash flow, the definition, if you will, simply put, is that cash flow is a measure of cash into the business versus cash out. Better cash flow management is going to lead to more profits and overall more lending. So positive cash flow. I'd like to break down how do you quantify positive cash flow? So one, the stronger the cash flow, the larger the funding limits, the better the overall bank relationship. And then in addition to having a stronger bank relationship, you can leverage that for additional lending and negotiating rates. So I'll break that down super quickly. So when it comes to additional lending, let's say a bank approves you for $30,000, but you know that you should easily, based on your income, be qualified for 75 to 100 grand. So what this does is now, let's say your last 3 months bank statements are extremely strong. You did 40, 50, 80,000 a month. Now, if we want to negotiate or push back and say, hey, we should be able to get a larger limit here, that cash flow and being able to submit those 3 months of bank statements to validate that is only going to further serve your case. And a bank might go from 30,000 all the way as much as 70, 80,000 just because you can show the proof of income. And then the last thing is negotiating rates. It kind of looks like this. If you start a relationship with Chase Bank, they offer you a $50,000 line of credit at a 12% interest rate. But then at the same time, you also have an offer from Bank of America at a 10% rate for the same amount of capital. Because of your income, you basically have afforded yourself that negotiating power to decide if you want to take either both, if you only want to take one, or better yet, you go back to the initial lender, Chase is this example, push back on them and say, hey, I appreciate the offer, but I already have an offer for 10%. If you guys can come down, I'll happily take it. So as you can see, there's obviously massive leverage in paying attention and close detail to your daily deposit volume. So we just broke that down. All right. So now let's dive into each factor and break it down specifically. So daily deposits, what does that look like? So regular and consistent daily deposits are going to counterbalance having a less than perfect credit score, presenting your business as credit worthy. So I'd like to explain that super quick. So basically, if you have income, if you go back to those three qualifiers for lending, if you have income and your credit isn't perfect, business credit or personal credit, having income is a lever that we can now pull on that may allow you to qualify if you don't have perfect credit. Two, you want to aim to deposit earnings daily or as frequently as possible to maintain a strong transaction record. So I know every business is different. Some businesses are seasonal. The way that they transact with their clients may only be once a month versus 5 times or 10 or 15 times a month. But no matter what, as you're managing your affairs and kind of structuring out how your business's cash flow works, you want to aim to have as many daily deposits as you possibly can because, again, you're building that internal rating now with that institution. Number three is you want to automate your cash flow to ensure consistency and reliability in your deposits. So instead of making this a luck event or let's see what happens or kind of let the business determine it, it's way better to use QuickBooks, payment processing, subscription models, etc., and different strategies that you can bring to the table, different things that you can leverage so that you can get one, maximum funding, but in addition to that, obviously increasing your cash flow for your business too. So the second part is total monthly deposit volume. This is part two on qualifying using your cash flow. So banks often consider consistent growth in deposit volumes as a basis for increasing credit limits and for approving larger loans. Kind of explained that already, so I'm not going to go too deep into that. Now, using financial software to track and project your deposits accurately can lead to predictable growth trends. So this is awesome. So a lot of our clients leverage QuickBooks to determine, of course, how much they've made per month or how much they're making on a daily basis, weekly and monthly, and then they can kind of determine that out. But then there's another side, which is your AR report or accounts receivables and potential incomes to come. You can leverage putting down your projected revenue and your AR report as another qualifier to help you get more capital. Lastly, is you want to diversify your revenue sources to boost your total deposits and make sure that your business is more appealing for substantial funding. So obviously having income coming in from multiple different places is going to help as well. So this is simple daily ending balance. Just keep it as simple as if you deposited $5,000 today, and then at the end of the day, you only have $50 left. That looks like a negative cash flow day in the eyes of the bank. So they're actually qualifying daily and monthly when it comes to your ledger, how much is on your balance. So strong ending balance daily is going to lead to better rates. Obviously, we just stated, review and adjust your expenditures to make sure that your balances are always on point, and then plan major expenditures after receiving payments versus, if your account right now is at 10,000 and you're going to receive a $40,000 check, and then you have to pay 20 grand for some equipment, I would wait for that 40 grand to hit. Let that daily balance hit for 1 or 2 times, and then obviously go ahead and make that payment for maximizing that opportunity. And then your end of month balance or free cash flow. This is probably the most important number. Not to knock down any of the other. They're actually all extremely important, but I would say this is the one of the main ones that they're using for qualification for large limits. So lenders often use that end of month balance as a snapshot of your financial resistance and long-term viability. Simply put, if you have a lot of money in the bank at the end of the month, that looks like a strong business. They want you to schedule I want you to schedule regular financial check-ins before the month ends to ensure all the transactions align with your financial goals. So how much possible cash can we drop into that bank at the end of the month so that end of month ledger, that end of month balance is as large as possible. Manage your billing cycles and outgoing payments strategically to optimize for your month end balance. Kind of speaks for itself. That number that they say is the remaining balance at the end of the month is your golden ticket. Again, as I've reiterated, that's your golden ticket to more funding. So if a business does 100,000 a month and then at the end of the month they close out that statement with 88 grand, that business looked like on paper that it just made $88,000 in profit, and it only cost them $12,000 to do that. Whether or not that's completely accurate and true, these are data points. These are and in a lot of cases, it's artificial intelligence and software that's verifying these data points and applications. So we're basically just doing our best to maximize that opportunity. All right, perfect. And then these are some $1 million hacks and some final thoughts. And I appreciate your time and kind of sticking with me here through this video. I know some of this information can be a little bit grueling. So 1, when preparing for funding, look at every 3 months like a full year of income. Lenders will judge you on 3-month increments to determine financial strength of the business. So banks and lenders are aware that businesses are seasonal. You could have a 30, 60, 90-day swing where most of your revenue is. So they look at each quarter or each 3-month window as an opportunity to determine how much that business is projecting in current cash flow and new cash flow. So use that to your advantage, 3-month increments. If you offer more than one service in your business, you should likely have multiple companies for each income source and then move that cash flow appropriately. Again, not financial advice, but what I've always found and learned from my mentors is that if you have a consulting service where you guys offer, a marketing ads for a company, and then in addition to that service, you also have a service where you connect them to other clients. Like you might have like a referral system. Those are technically two different business models. And in the purposes of today's video, you would want to have the cash flow hit both businesses. And then if the initial business, the initial marketing company as a whole is the one who really supports the secondary business that handles the referrals, then you would want to move that cash flow from the first business over to the second one as like another income source or a consulting fee to that first entity. And now you can see, having multiple entities, you can actually stack your income and increase those bank statements. Now you want to structure your billing dates to accommodate strong end of month daily balances. We already talked about that. Today's lending environment requires more and more documentation. It's almost like every few months they're asking for more and more. So when we're able to send an application in with 3 statements and a profit and loss sheet to a lender at the point of application, they love that because they can see this business is serious. They're making money. They're not trying to hide or withhold information, and they're willing to kind of come forthright to the table to be able to get themselves taken care of. And then lenders typically give out, this is critical, so lenders typically give out 10 to 20% of the gross cash flow in credit limits. So gross, that's your top number. Use that knowledge to your advantage. So if every month you're doing 80 to 100,000, you could start to map that out as to how much that would look like on an annual basis, because they're going to judge you on an annual basis. So 80,000 a month, whatever. Let's just say that that's 1.8 million a year. They're going to judge you on that annual basis and then determine how much they're willing to risk or lend to you based on that number. And then, of course, like we've talked about at length in today's video, what are those ending daily balances and what does that end of month balance look like? So hope this was super helpful. Really appreciate your time, energy, and effort and committing to learning this. I hope you take notes. Please listen again if you miss anything. But, again, doing this for so many years, this is by far one of the most important things that people can consider, especially if they want to get large limit funding and if they want to get unsecured business lines of credit. Frankly, without strong cash flow and paying close attention to how you're managing your affairs, it's not even going to be possible. So hope this was super helpful. Thanks again. Justin coming at you. Continue to tap in for more and be on the lookout for the next video. Let's go.